consumer price index month over month rising 0.3%. That is in line with the average economist estimate. But if you strip out volatile food and energy costs, you get a gain of 0.2%. That is versus the 0.3% that was estimated by economists. So again, the core inflation number on the consumer level coming in better than had been anticipated. If you look at the year-over-year numbers, you get exactly the same picture. On a year-over-year basis, rising 2.7%, and a core year-over-year basis rising 2.6%, which matches the prior month and again is 0.1% better than had been estimated. And there were a lot of questions surrounding this report because of the government shutdown, because of the prior CPI report and the survey period and some tweaks that some economists had questioned about how that report was put together and sort of how clean, quote unquote, the data was. So this report being seen as a better, more credible data and sort of confirming that we are seeing a little bit of a slowdown in the inflationary picture here. I need to go through and look at the components, as I'm sure that our guests are going to be doing as well. But the shelter component going to be really important in here because that was one of the more questionable or volatile elements within the last report here. And I'm seeing here that the index for shelter was up 0.4% in December. It was the largest factor, according to the Bureau of Labor Statistics, in all of the monthly items that they track. The food index was up 0.7%. That includes both food at home and food away from home. The index for energy up 0.3%. But again, you take out those food and energy costs when you look at the core number. Shelter, the biggest change and the biggest components there. So that's something to continue to keep an eye on here. And again, the core number up 2.6% on a year-over-year basis. And joining me now to break down the CPI report is Jennifer Lee, BMO Capital Markets Senior Economist and Managing Director, Claudia Sahm, New Century Advisors Chief Economist and former Federal Reserve Board Economist, and George Bory, Allspring Global Investments Chief Investment Strategist for Fixed Income. Everybody, thanks so much for being here. Jennifer, let's start with you here. It looks like that this is a confirmation of the sort of disinflationary trend. Is that how you're reading these numbers?
Good morning, and thank you very much for having me on this esteemed panel. Yeah, it looks like it's everything was basically in line with expectations, better for the core, as you mentioned. So this is good news in the sense that nothing is really, for this report as it stands, standing in the way for further rate cuts from the Federal Reserve. You know, when that's going to happen is another story. And of course, they are dealing with a whole lot of other hoopla going on right now as well. But in terms of for the economy, it shows that there is some more, easing price pressures. But I will point out that food, again, at a glance, looks like it was still up 0.7%, which is still fairly high. And this is what consumers are looking at, right? This is what you're seeing on a regular basis when you're pushing your cart around the grocery store, and these are all about groceries. So that's something that still needs to be worked on.
Claudia, I know you were paying a lot of attention to that shelter component. Again, as I mentioned, because of the prior survey, some assumptions perhaps that the BLS had made. So the shelter going up 0.4% in December, what does that tell you?
Right. And I would add to that, the discussions about Fed officials like Stephen Myron, who are looking for a lot more disinflation this year, really focus on what's happening with shelter and the possibility that that really turns down. And I think looking at the data, even coming into this report in September, owner's equivalent rent was really mild in terms of a month over month reading. And today what we see is something closer to 0.3, which has been, a slower pace than we've seen in recent years, but not a dramatic drop off. So what I would say in looking at the monthly rates for owner's equivalent rent, for tenants rent, they're showing that we've had disinflation in the shelter component, but it's not that it's really driving kind of the inflation trend down.
And George, let's get your impressions here and what the implications are for the rates markets.
Yeah, well, as my colleagues just mentioned, the disinflationary trend does look like it's in place. It may have hit a little bit of an air pocket at the end of last year, but it does look like this slow, steady kind of deceleration of price increases is unfolding. It's not evenly spread across the economy, and we know that there's still some noise in the data, but we don't need to be worried about accelerating inflation at this point. And so when you look at the bond market, we're seeing bond prices kind of pop up a little bit, not hugely, but it does sort of keep the window open, if you will, or the door open, whichever channel you want to get yourself through, for the Fed to continue with their easing bias. They don't. There's no urgency to move, although the president would like them to move a lot more quickly. But the data suggests that they can continue down this easing path. They can have a bias towards easing policy without the fear that inflation is going to run away from them anytime soon. And so we're seeing a little bit of a bid to the front end. The long end has come down a bit, but remains fairly elevated. As I think maybe it was Claudia just mentioned, obviously the Fed is facing a lot of challenges right now, and markets are still kind of asking themselves what to expect from the Fed longer term, and whether or not rates are going to come down substantially, and that accelerates inflation perhaps later in the year, the second half of next year, this year, or maybe into next. But that's still, those are worries we can worry about, sort of 6 months out. So for now, pretty good for the bond market. It seems like stocks like it as well because it keeps the Fed in play. And this whole notion that easier monetary policy is coming at a slow pace, consistent with inflation, should help financial markets.
Well, I am curious if others on the panel see any coming upside risks to inflation at all. Claudia, I'll start with you on that. I mean, there's a lot of talk about the stimulus that's coming from the tax bill that's sort of going to be coming into the economy early this year. Any risks there that we could see upside pressure on inflation as a result of that?
Well, absolutely. I mean, that's a support to demand. It's been something of a puzzle that the extra costs that the tariffs have generated have really sat with U.S. businesses, and we haven't seen the pass through to consumers. Sometimes we see business talking about, price pressures on consumers. They're more sensitive. And if you have a moment where people are a little bit more flush with cash, then they're less sensitive. So it may be an opportunity for businesses to pass on more of those costs, or just costs in general in terms of higher prices. So it's something to watch. And I'm still skeptical that we've, seen all of the distortions to the data work their way through. I think the data fog of measurement is lifting gradually. So I'm not convinced this is an absolutely clean year-over-year read at this point. But, in terms of big accelerations, I don't see that in the forecast.
Gotcha. Jen, what about you? What are some of the upside risks that you're watching to inflation? Or conversely, do you think that things are going to come down more quickly than perhaps we're expecting?
So full disclosure, at the beginning of the year, beginning of last year, I thought that we would be seeing a lot more inflationary pressures, just given, especially from the tariff front. But like Claudia just mentioned, it's amazing how businesses have been able to absorb or hold on to a lot of these gains. But, I don't think that's going to last forever. We've heard some rumblings from big corporations that, there are higher prices coming down the pipe. So we'll see how that goes. It certainly helps that we've seen a lot of these potential pressures coming from, from the government in terms of oil prices and housing, and of course on food prices like Italian pasta or Brazilian coffee or something like that. Electricity that we saw this morning, pressures on the tech sector. At the same time, other things that policies can't directly completely influence is like, climate issues as well, and all the wonky weather that we're seeing has played havoc on food prices. I'm going back to food again, because this is what consumers are seeing instantly or on a regular basis. We saw sky high prices of rice in Japan. Record high oil prices, I believe, in Spain, as an example. Especially, and also on the demographic front, the fact that we're seeing, smaller labor supply because of all the deportation issues. At the same time, we're also seeing there's also the probability that U.S. population growth is going to start slowing even more meaningfully, and that could potentially put upward pressure on wages. But that's more of a longer term story. So I don't think we're completely out of the woods just yet.
Joining me now to discuss, Jeremy Schwartz, WisdomTree Global Chief Investment Officer, and our Federal Reserve correspondent, Jennifer Schonberger. Jen, I'm going to start with you here. And what stood out to you from the CPI report, especially given the sort of wonky end of 2025 that we had in terms of data collection?
Yeah, absolutely, Julie. I mean, core CPI coming in a little bit lighter than expected, 2.6. But you know what? That was holding the same level of September through November. So that shows it's still a bit sticky there for the last 4 months of 2025. And so I don't think the Fed really moves on this or changes course for the end of this month. That is, I expect them to take a breather from rate cuts and hold steady. But like you said, the data's been a bit wonky, and we should probably take this print with a little bit of a grain of salt, because the data is likely skewed from the past collections that we saw for October, or lack thereof, I should say, and then November. The BLS seemingly had to back into some of the calculations, particularly for shelter, and seemingly penciled in 0 for shelter, which is why we saw such an increase of 0.4%, which really contributed to the upward pressure here. So I wonder how much of this is skewed. I think we're going to have to see a couple more year-over-year readings before we start to get a clean take on this. Perhaps this number coming in a little bit higher than what it could have been.
Jeremy, what's your take on the numbers? How sort of seriously or literally or whatever you want to call it are you taking CPI?
Well, it's great to be on with you both. I actually have been following this trend on shelter for a long time, and we actually think there's a lot of issues in the calculation of shelter, not just in the last month. We put out our own measure of inflation using more real-time measures of shelter. The official BLS number year over year is 3.2. When I look at things like apartment list, has negative. It's declining. And I look at Zillow, it sort of average the two together. I have a 0.5 on shelter. And when I plug that in to just basically doing that simple substitution to CPI, I get core CPI at 1.6 and headline at 1.85. So shelter's had a lot of issues for a while. This was one of the things we saw shelter spiking in 21 when the Fed was saying it was a transitory, real inflation was much higher. Now it's actually much lower. And so this should be comforting for the Fed if they start looking at sort of these alternative measures of shelter.
Do you think they will? Do you think they are, Jeremy?
There's commentary. We were alone talking about this for a while. You see a lot of it talking about it. And so I do think this is part of the thing that's offering the trend. I'd say the trend's their friend. It's going to come down officially over the next 12 months.
And Jen, it doesn't seem to change what's going to happen at the January meeting. Especially given the sort of political cloud around the Fed right now. But what have you heard from Fed officials in terms of the alternative data or how they're reading shelter?
Well, to Jeremy's point, we heard from New York Fed President John Williams, and he does expect inflation to come down in the second half of the year. He's quite bullish, actually, on the outlook for the economy this year. He thinks inflation is going to peak in the first half of this year before it starts coming back down, and will end the year just below 2.5%, which is pretty reassuring, though he seemed to indicate that the Fed is okay to hold right here, right now, because he said that rates are well positioned to bring down inflation while also supporting the labor market. And so he seemed to indicate, look, we did 3 rate cuts at the end of last year. We took out that insurance, and we're well positioned to sort of sit here and look around. So it looks like, to Jeremy's point, they do expect to see inflation start to come down. Those one-off impacts from the tariffs start to come out of the data. And they think if you account for those tariffs and you take those out, inflation's still on its downward trajectory.
Of course, all of this comes amidst the backdrop of Jay Powell sort of opening a new front, as it were, in the sort of conflict with the administration. And Jeremy, this morning, both JP Morgan CEO Jamie Dimon, as well as BNY Mellon CEO Robin Vince, on their conference calls or on calls with media, sort of lending support to the idea of Fed independence. Does that surprise you? I mean, they've been sort of apolitical, many of the CEOs. What does it tell you that they're speaking out on this?
Well, there's no guarantee the Fed can be independent. The Fed is a creature of Congress. So one of the things we were saying, our senior economist, Jeremy Siegel, was saying earlier, and people were raising their eyebrows, that Powell should have resigned and put it all on Trump, and said, he was actually in some ways compromising the Fed independence by staying where he was. So there's, different takes on that question. But I think the trajectory is on the right path. They're not far from neutral. We think they should be 2 to 3 cuts below where they are. But you're getting a more normal yield curve shape. For a while, we had a very inverted yield curve where the Fed funds was higher than the 10-year. You're now, 50, 60 basis points positively sloped. It should be like 100, which is why I say two more cuts would be probably appropriate. But you're getting close to neutral, and so they're on the right path, and we'd like them to be there sooner, but they're not far from being neutral.
Jeremy, let's get to stock strategy here for a second, or multi-asset strategy as well. So you've got what's going on with the economy and the Fed. You've got what's going on geopolitically also increasingly between Venezuela and Iran, et cetera. Yeah. Are you tweaking strategy at all, given some of the backdrop here?
It's an interesting, you've had basically two themes, AI and US tech leadership dominating all the global markets for the last 15 years. Last year, it was sort of this beginning of the year, you questioned US exceptions. We started seeing international start to outperform. You haven't seen really the broadening, the smaller caps take leadership from large caps. As you go through earnings season, one of the things we're watching is, will the AI benefits everybody? And I think the consumers of the technology are going to start to see margin improvement. You're seeing it with the Fed lowering rates. It's helpful for borrowers, sort of small cap companies, and the valuations are much more supportive there. And so I think that's the key thing we're watching. We do think there's this rotation coming, but also international has been ignored for a while, and there's still a lot of very, very good valuations outside the US. And I think that is, we call it the defense tech super cycle. All this spending on defense in Europe, in Asia defense is probably one of our top themes looking ahead. But that spending is going to lead to a lot of innovation, and we think we'll get a lot of new technologies out of international. And so I think people have been underallocated there.
And I know that you guys like Japan in particular.
So Japan, the Takaichi trades have been very, very hot. Even overnight recently, you saw more sentiment, bullish sentiment coming to Japan. It's been one of our favorite markets for a long time. Our Japan Opportunities Fund, OPPJ, has a 12 PE. It has all the Buffett stocks that he's been buying. The top 5 holdings in those names are almost 40%, 45% of the fund. But 12 PE, when the S&P is 24 PE, is a very attractive number. And these companies are growing and doing a lot of good things with increasing dividends and buybacks. So that's one of our top ideas when you go overseas.
We're seeing some yen action, I know, overnight, the yen sinking. How does that inform the trade that you're talking about?
Yeah, the currency is one thing people get wrong all the time. We've been suggesting you should be thoughtful about how you manage currency risk. Most people, when they buy Japan, they just buy the yen. And if you did that, you were, significantly last decade, your returns were something like 7% versus 14% a year for the last 10, 12 years. So people bet wrong on the yen. At 160, it's getting, it's not a cheap, undervalued currency, but things can be surprising when you go to the currency market. So we try to have a thoughtful approach on how do we hedge that risk. You're still getting paid to hedge that risk. And, we are, more hedged than we're not in that Japan Opportunities Fund.
Jeremy, good to see you. Thank you. And our Jennifer Schonberger, as always, tracking the economic data and the Fed. Appreciate it.
Thanks, Julie.
We're starting to get into bank earnings. And of course, someone right off the bat asked Jamie Dimon on the JP Morgan conference call about the Fed. And here's what he said. I do have enormous respect for Jay Powell. Everyone we know believes in Fed independence. Anything that chips away at that is probably not a great idea. And in addition to that, BNY CEO also, saying some supportive things. In fact, pretty much everybody from members of Congress to former Federal Reserve chairs have said that what the administration is attempting to do is a bad idea. So I guess, George, what is the market pricing in as the probability that they're going to keep at this or go through with it? And how should we sort of be thinking about this? Was it a trial balloon? What was this?
Yeah, no, that's a really good point. I mean, if we look at the market, sort of started to price in the idea that Powell stays on longer than expected. And so there's some unintended consequences of, the maneuvering or the, sort of the challenges that the Fed faces. And as Powell mentioned, sort of it's not unprecedented for a Fed chair or the Fed in general to get pressure from either the administration or other politicians who would like to see easier policy. This seems to be extraordinary and much more intense than anything that we've seen in the past. But still, it's their job to basically stick to the mandate, which is follow the data, respond to the economic conditions, and set policy where they think, where they're able to try to help foster long-term growth in the broader U.S. economy. Now, there's a strong argument for independence, and unfortunately, the outcome is never immediate. And so right now, I think financial markets, bond market in particular, is taking a somewhat benign view. But we'll have to see. We'll have to see how much more pressure is ultimately implemented, and whether or not this is sort of high stakes poker or intense negotiations, if you will, rather than the actuality of being able to truly influence monetary policy. Powell put up a pretty good defense over the weekend. I suspect, or we suspect, that he has the support of a large percentage of the board. And so policymakers, the Fed in particular, we think will stick to the mandate. The mandate is stable prices and full employment, based on the data that they're seeing from the economy. And we think that will be the ultimate principle. They're clearly under a lot of pressure to take policy easier, but there is structure within the Fed to prevent that from happening in the extreme.
Claudia, do you share that confidence that these attempts to sort of jawbone policy won't be successful?
So I'm less optimistic over the longer run, right? This is the pressure campaign on the Fed has escalated over the past year. I don't think this latest salvo is going to be successful, and I think it could very well backfire. But I mean, Powell is towards the end of his tenure as chair. We have, a new chair will be announced soon, has to go through confirmation. I mean, this is going to be a pretty chaotic transition, and it's, there've been a lot of statements like Jamie Dimon's over some time now about why the Fed should be let to do its job, and yet the administration keeps coming back and applying more pressure. So I just am concerned that over time, the guardrails, there being a lot of pressure is being put on the structure of the Fed to kind of hold together, and how long does that really last?